If you're 65 or older and you own your home, there's a very good chance your state is offering you a property tax break right now that you've never claimed. And here's the twist that trips up almost everyone who looks into this: there is no single federal program for it. No ERS formed specifically for this, no Social Security office involved. This lies entirely at the state and county level, which is exactly why so many people miss it completely. Every state handles it differently, and almost none of them will ever tell you automatically that you qualify. So let's walk through the 4 different forms this relief actually takes. Look at real numbers from real states, and then talk about exactly which office you need to call in yours. Let's clear up the biggest point of confusion first. There's a federal deduction called SALT, short for state and local tax, that lets you deduct up to $10,000 in property and other state taxes on your federal return if you itemize. Some people hear about that and assume it's a senior benefit. It isn't. It's available to any taxpayer of any age who itemizes their deductions. It has nothing to do with how old you are. Real senior-specific relief lives at the state level, and it generally shows up in one of 4 forms. An exemption reduces the taxable value of your home before the tax rate gets applied to it. A freeze locks your assessed value in place, so even if home values in your neighborhood keep climbing, the number your tax bill is based on doesn't move with them. A circuit breaker, sometimes called a credit or a rebate, triggers a refund when your property tax bill starts eating up too large a share of your income. And a deferral lets you post-hang-fo one, paying your property taxes altogether while you continue living in the home. That last one, deferral, needs a clear warning attached to it right now, because people often misunderstand what it actually is. A deferral is not free money. It's a loan against your house. The state pays the tax on your behalf, but that amount becomes a lien on your property. And it eventually gets repaid, usually with interest, when you sell the home or when it passes into your estate. It can absolutely be the right tool if you need cash flow now and plan to stay in the home long term. But it does reduce what you eventually leave behind, and it's worth going in with your eyes open about that trade-off. Let me show you how differently this looks depending on where you live, because in some states, the dollar impact is genuinely enormous. Picture Robert and Linda, both 68 years old, homeowners in Texas, with a home assessed at $310,000. Under the 2026 rules, Texas gives every homeowner a general homestead exemption of $140,000 off the assessed value used for school taxes. On top of that, because they are both over 65, they qualify for an additional $60,000 senior exemption. Combined, that's $200,000 shielded from school taxes, which brings their taxable value down to just $110,000. And Texas goes a step further with something called a school tax ceiling. It locks the actual dollar amount of their school tax bill at the level from the year they first qualified. So even if their home's value keeps rising after that point, their school tax payment stays frozen right where it was. Now let's look at the other 3 tools through real examples from other states, because the shape of the benefit changes quite a bit depending on which mechanism your state uses. New Jersey runs one of the more aggressive newer programs in the country called Stay NJ. For homeowners 65 and older, it reimburses up to 50% of your annual property tax bill, capped at $6,500 a year. If your property tax bill runs around $8,000, that can put roughly $4,000 back in your pocket. Illinois, particularly Cook County, uses a freeze if your household income falls under roughly $65,000 to $75,000. The exact threshold depends on which filing year applies to your specific bill. The county locks your home's equalized assessed value in place so it stops climbing. Illinois also runs a separate deferral program that can post-hang-phone up to $7,500 in property taxes a year at 3% interest. Massachusetts uses a true circuit breaker. If your property tax bill exceeds 10% of your total income, you become eligible for a credit projected at up to about $2,820 for 2026. This one gets calculated directly on your state income tax return through a specific schedule, so it's worth asking your tax preparer directly whether they've actually included it, since it's easy to overlook. New York splits its relief across several separate pieces rather than one single program. There's Enhanced Star, which reduces your school tax bill if you're 60. 5 or older and under the income limit. Many localities layer a separate senior citizens exemption on top of that, which in some areas can now reduce your assessed value by up to 5%. And if your income is very low, $18,000 a year or under, there's a refundable credit worth up to $375 through a specific tax form. New York City runs its own version of the senior exemption on top of all that. And since I want you to understand the real cost of deferral programs, not just the surface benefit, let's compare a few. California's property tax post-hankfament program is available starting at age 62 for households with income at or below roughly $55,000. And it charges 7% simple interest. Vermont, by contrast, offers one of the most generous deferral structures in the entire country at 0% interest. Oregon raised its deferral income limit to $70,000 for 2026. The rate and the terms swing enormously from state to state, which is exactly why deferral isn't a single national number the way a federal program would be across the country. Roughly 29 states plus Washington, D.C. operate some version of an income-based circuit breaker. Nearly every state offers at least one of these four tools in some form. The dollar amount, the age cutoff usually 65, though some programs start as early as 62 and a few require you to be 67, and the income limit all depend entirely on where you actually live. Now, a few details that trip people up more than anything else, and these matter just as much as the numbers themselves. First, none of this is automatic. Your county assessor doesn't flag your account on their own and quietly apply a senior exemption for you. You have to find the application yourself and file it, and in most states. You have to do that in the specific year you first become eligible, commonly within a window somewhere between January and April, though the exact date varies by state and even by county within the same state. Second, missing that deadline is usually final for that tax year. Most states will not let you go back and recover an exemption you simply forgot to file for. There are exceptions. So Texas, for example, allows the age 65 exemption to be filed up to 2 years after the date you first became eligible, which is unusually generous compared to most states. Well, don't assume your state works the same way. Check directly with your assessor's office. Third, circuit breaker and deferral programs often require you to reapply every single year. Well, a basic homestead or senior exemption, once it's granted, typically just continues on its own as long as you keep meeting the requirements. Get clear on which type of program you're dealing with, because the renewal expectations are completely different between them. Fourth, pay attention to how your state defines income for these programs. Several states use a sliding scale rather than a hard cutoff, and some specifically exclude Social Security benefits or unreimbursed medical expenses from what counts toward the limit, if you're within 10 or 15% of a stated income threshold. It's genuinely worth calling the assessor's office directly and asking exactly what counts before you assume you're over the line and rule yourself out. Well, fifth, and this matters if you're helping a parent with most of these programs, let an adult child file the application on a parent's behalf using their signature or a power of attorney. Well, if a parent is overwhelmed by the paperwork, this is one of the highest value things you can do for them. Most applications are a single page plus a few supporting documents. Well, nothing more complicated than that, and one more thing worth a direct warning, because this space attracts exactly the kind of scam you'd expect if you get a call, a letter, or someone knocking on your door offering to lock in your senior exemption or your freeze for an upfront fee. Be skeptical. Filing directly with your county assessor or your state Department of Revenue costs nothing. Nobody legitimate needs to be paid to submit a form on your behalf. Here's exactly what to do with all of this. First, pull out your most recent property tax bill or assessment notice and look for any exemption that might already be listed on it. Sometimes a basic homestead exemption is already applied, and you're only missing the senior specific layer that goes on top of it. Second, call your county assessor's office directly and ask this exact question: what property tax relief programs are available to homeowners age 60, 5 and older in this county, and what's this year's filing deadline? Third, check whether your state offers more than one of these tools, because many states let you stack a homestead exemption, a senior exemption, and a freeze or circuit breaker together, and the combined savings can end up significantly larger than any single program on its own, if you're not sure where to even begin. Your local area agency on aging usually keeps a simplified list of what's available specifically in your area. This is money that's sitting on the table in almost every state in the country. And the only thing standing between you and it in most cases is one phone call and a single form. A quick disclaimer before we close this video is for educational purposes only and isn't personalized tax or legal advice. Property tax relief programs are set at the state and county level. They change frequently and they vary enormously by location. Confirm the exact rules, deadlines, and income limits with your county assessor or your state Department of Revenue before applying.